I'd like to introduce, and many of you already know him, Gabriel Davel. He will present our next panel topic. So welcome.
Apologies for all of this. This is from playing too much sport with lots of millennials and jumping around like a mad idiot. Good. What I'm going to try to cover is a little bit of a traditionalist, old-fashioned reflection on where credit market problems come from in many countries. We've had many fairly significant market failures. I've lived through some of these in South Africa. So then obviously shifting immediately to digital credit. How do I, as a bit of a traditionalist, see these problems in digital credit? And only one or two small comments on, again, from a bit of a traditionalist, on where I see the priorities. And then we're going to have the panelists taking over and probably repeat a part. Just one or two comments on that little graph, that little curve that you see, is what we've seen in South Africa and many markets, is that in the time that the new technology get introduced, lots of enthusiasm, the market grow like hell, lots of providers pile in, the profitability is really high. Often, lots of replication of the same technology, targeting the same client groups. At some point there at the top of the market, things could not go better. Everybody's starting to get worried, but the loss levels, the NPL levels are surprisingly low. Well, we know why, because people borrow from different borrowers to settle. The consumers are now at the point when they're at a very high debt level already. And the fallout happens surprisingly quick. I mean, I remember I went on holiday in November. By March the next year, we had a bank failure, and by June, by 2 months later, we had 2 or 3 bank failures in the country. From no concern to a complete fall-off. Well, I'm going to say this a few times more. And the regulators, the regulating group, worry themselves to death about the institutions that's affected, with very little concern about hundreds of thousands, sometimes millions of consumers that end up with bad records, and I think somehow worse, with terrible credit culture that will remain in that country possibly for decades. They are the common factors, whether you talk about South Africa, Morocco, Bolivia, Bosnia, the many, many failures. Third-party origination, agents and brokers, a step removed from the principal lenders. In South Africa, it was a huge factor, one of the biggest factors. In Andhra Pradesh and India, a huge factor. Investors that come in with lots of money, huge growth targets, that then leads to very aggressive targets from the institutions that drives a behavior throughout the country. So these are common factors that often causes the market failures. The first big question we have to ask ourselves when we talk about digital, though, is which digital credit are we talking about? Because when I read the statistics, I'm an accountant, I try to reconcile it. In China, 93% of all credit is classified as digital. Now, is a definition that is this broad at all useful? Because we do really have to start focusing on where do we see the problems. Now, in my perception, my naive perception, it does come from mobile instant credit, high-cost short-term credit. Let's try to change our focus on these areas of real risk in the context also that if I apply for a mortgage through a laptop, then why should the normal consumer protection rules not be sufficient? Let me move on. Over the last 2, 3, 4 years, 5 years, there's been a heap of research from places like CGAP, IPA, and SIGA on actual problems, very real problems in very, very big percentage. I mean, the number I remember is something like 69% of digital apps that had some significant consumer protection problems built into them. 14% from somewhere else. You know, these are big numbers of consumers that's affected negatively through digital credit. It's not something we can ignore. Let's move on to the actual problems, and I'm getting to the end here. Is the stuff that comes through here is bad disclosure, misleading disclosure, agents and brokers that do not, well, either do not have a fee schedule or that just tell the client whatever the charges are that they may have. Very high default rates. Lots of re-advances, debt levels that go on. Now the quote, where are we? Just the one for me, a quote from Kate McKee and Rafe Naze's paper, is that the very attributes of digital credit in terms of disclosure through this mobile device, that is where we have our problems. And let's focus on that as the area of problem. Let's move on if we can. So this is my last slide. So just to try to pull this all together, I mean, we have this digital technology that has got huge, huge potential. We're targeting the technology at low-income countries across the world where the regulators are either not interested or have very limited capacity, and where the clients are quite vulnerable. They do not have a lot of surplus. They are living in unstable countries, politics that's unstable, climate risk. Can we afford to add further financial burden to this client group? Three things for me that really stands out that we have to look at going forward. Early warning indicators, not just to the regulators. There's too much talk here of regulators. When an investor invests in a digital platform in any country, they should be the ones that make sure that these minimum mechanisms are in place. Second point, minimum ground rules. Find out what are the negative practices and prohibit them. This thing about general guidelines of good practices, it's not the way to go. Get ground rules in place so that the game can continue within certain parameters. Last but by far not least, effective consumer complaints and redress mechanisms. So that when a consumer is worried, damaged, don't know what to do, they've got somewhere to call where they are not going to talk to a chatbot, where they're going to have a human that take this up, so that you can generate statistics on what's going wrong, and you can help that specific consumer. Finished. Move on.
All right, no more ice hockey for him. Okay, great. Let me invite Natasha and our next group of panelists up to the stage, please. We're going to continue this conversation. So would the other panelists please come up?
While they're coming up, thank you to our panel, and let's have a round of applause for Gabriel Davel, who gave us this introduction on digital credit, and for our wonderful panelists, please take a seat. While they're taking a seat and getting situated, please go ahead. What we're going to do is we're going to look jointly now at the responses you provided to those Menti questions that we asked you. And in case you're wondering where we are on the agenda, we are at the point in time where we're doing a panel session on digital credit. So this morning we started with the welcome and introductions. We did a deep dive on DPI. Then we looked at AI and data. And now we're at that pre-coffee break moment where we're going to talk a little bit about digital credit. Now, let me see first, what did you say when we asked you for the markets where you work? Do you have an accurate idea of the number of borrowers who use digital credit? And what we see here is the democracy has not entirely worked. Only 44 people have voted, and we would have expected something closer to 100. But of the people that did vote, about two-thirds or 32 of you said that it's hard for you to assess and have an accurate idea of the number of borrowers who use digital credit. This is largely what we expected. So now let us go to the next question. and ask you whether you think digital credit is a source of concern for consumer over-indebtedness, which is really why we are having this session. You know, in the preparation for today's session, we had a lot of conversations with many of you, and some people have said, well, why are you worried about digital credit? Can people really become over-indebted on mobile, instant, nano credit? Is this really an area of concern? So we took your question, and first we wanted to pose it back to you, and then we heard a little bit from Gabriel Davel, ex-South African credit regulator, but let's ask you and see your responses. And what you say is 36, 37 of you said, yes, it can still be a source of concern. 6 say no, and 7 say, I don't know. Okay. The next question is, does it present a significant amount of arrears? So you will remember, for those of you who work in the field, who have been working in this field for a while, there were a lot of concerns at one point that happened in Kenya, where there was a prevalence of digital credit, and then some 2 million borrowers became negatively credit listed for non-payment of small loans. So here we are asking, do arrears due to non-payment of digital credit represent a significant amount of arrears in the markets where you work? And again, we're seeing this issue of a lack of information informing the red bar, where 27 people say difficult to assess, we don't have enough data. 14 people said yes, it is a significant amount, and 7 people said no. Thank you for that. And we finally asked you the question that we have been grappling with ourselves, and that is, should we worry about the impact of digital credit on low-income households? And a lot of you, many of you, 41, said, yes, we should worry about impact of digital credit on low-income households. So the way that this session is structured, let me just give you a little more of the architecture of how we have designed it, is I'll ask each one of my panelists a question, they'll respond, and then we are going to, after each response, we'll also play you a video, a 4-minute video response from a guest, from a participant that was going to be in the audience, Francis Guerre from FSD Kenya, who is going to tell us also about lessons learned in Kenya. Unfortunately, Francis was unable to fly in, so he didn't join us here on the stage today, but we have the video from him. So and here with me, just so you know, from my very left, we have Mercedes Bidart, who has joined us from Kipu. You heard from Mercedes yesterday during the debrief session from Banco Palmas when she spoke a little bit. Welcome, Mercedes. Eric Duflo, who leads consumer protection work at CGAP. And then we have Ayushi Chaturvedi from Consumers International, who has flown in from London. Welcome, Ayushi. And Diego Cruz, who is here from the Central Bank of Brazil. I will ask my first question to you, Eric. At CGAP, you work on the responsible digital finance ecosystem. And we just saw from Gabriel's presentation, this is a rapidly developing field. What are some of the safeguards that we need to put in place to ensure a responsible digital finance ecosystem, and what are you finding in your work at CGAP?
Thank you very much, Natasha, and thank you for inviting me to join this panel. First of all, I'd like to put digital credit in the context of overall digital finance development. I don't know if you've seen this. I think many of you actually have seen this report, but in 2022, CGAP issued a report on the evolution of the nature of digital finance consumer risks and the evolution of the scale of these risks. And the bottom line is that we found significant evidence that there is growing frauds at the global level with digital financial services, and there is growing misuse of data. These were the ones where we had the most evidence of growth, and in many cases, we could see actually a faster growth of risks than the actual growth of the adoption of technology. So obviously this is raising a lot of questions, and in a way it's justifying, this meeting today, because there's a lot of work to do. On top of these experiences from consumers, we're seeing also a huge number of new players in the market, not just providers, but also even at the regulatory level. In the last 10 years, we've seen the arrival of data protection authorities in different countries, and I think we're going to see, more, maybe Ministry of Digital Economy, etc. So there are more actors involved directly or indirectly in digital finance. What we believe at CGAP, and we're developing a vision, we're trying to see how we can create a booster, if I may say, for digital finance, financial consumer protection. We call this the responsible digital finance ecosystem approach, and the goal of this booster is really to decrease risks for digital finance service users, but also ensure that they have a positive experience and positive outcomes. So it's not just about doing no harm, it's also about providing positive outcomes for consumers. So what it means, this booster, it means building on what exists already. It's not reinventing the wheel. But what we would like to see, and we're creating the tools for this to happen, is in different countries, more actors involved and collaborating on reducing risks and giving this good experience. That means having more providers at the table, more collaboration among different authorities, whether it's data protection authority or financial sector authority or AI authority if there is one, or overall consumer protection authority. So we would like to explore how we can foster these collaborations. Because as Carolina said this morning, this is not a simple issue that we're facing. And I don't think there is a simple answer for a complex issue here. So we need more of this collaboration. And the other thing we are promoting is more customer centricity. And what this means is more customer centricity also in the way things are being regulated, and also when developing different action plans to fix the issue of irresponsible digital finance, we think it's critical to start with a very comprehensive analysis of consumers' experiences with, for example, as we've done in West Africa, national surveys looking at digital finance risks, including digital credit. So some of the tools that we're developing specifically for digital credit, I'd like to talk about three examples. One is to monitor the risks. For example, we did this national survey in Côte d'Ivoire on digital credit. We found that 78% of users of digital credit were not repaying in time. It doesn't mean that they're going to go into over-indebtedness. We're not there, but this is an issue by itself. So it gives us some really interesting, information about the consumer. The second one is in terms of predicting potential defaults. We've been working with the 4G Capital in Kenya to develop a tool that can predict somehow, defaults, and it's kind of a stress test for borrowers that is being developed. And what we found in the research is that actually 80% of the consumers were facing some form of financial stress, which was a surprise. And we're not finished with the research. There were some predictive elements, but we're not totally sure yet whether we can predict. But if we manage to find, some interesting prediction pattern, I think that could be, an interesting tool for digital credit. And then the last one I would like to mention is the experience with the authority. In this case, well, actually, it's the RBI Innovation Hub. So it's a it's part of the RBI, but it's also a separate entity. We worked for them for about 2 years, 2-3 years, on how to better monitor digital credit in the market. So on this one, this was a social media monitoring tool on which we work that gave us tremendous information on the nature of the issues that consumers of digital credit were facing in India, in particular in the misuse of their data. And it could also help us identify some of the digital apps that were, wrongdoers. So I think there's a lot of potential also with technology, to create more responsible digital credit. So I'll just stop here for the sake of time.
Thank you, Eric. And I should have mentioned when I told you about the structure of the session that the reason I'm posing only one question to the panelists is we want to leave time at the end for all of you to then ask your questions. So please think what you would ask of the panelists as they talk about the issue of digital credit and the potential for over-indebtedness. So I'll turn over to you, Diogo. And as we were preparing to come to Brazil, we saw some reports that had come out previously that as many as 70 million Brazilians struggle to repay their debt on time. Now, we've also seen reports since then that defaults have gone down in 2023, but we still wanted to ask you, given that we're looking at the lessons learned and what some of the other markets can learn from you, especially as you have been involved in the measuring of financial resilience of citizens, and your focus on consumer protection as one of the 3 pillars of financial citizenship. Can you tell us what steps are you taking to ensure consumer protection and to address some of the debt stress that consumers might be experiencing here? Thank you.
Hello. Thank you, Natasha, for the invitation and the question. First, let me talk a bit about the Brazilian case in terms of measuring digital credit. It is not an easy task. We do have a very rich credit registry, but it's hard to find information about which channel customers take when they're taking their loans, which channel are they accessing when taking their loans. So we do have managed to kind of have a proxy of that, having taken into account all the institutions like fintechs and institutions, so-called digital banks, and institutions that basically have only digital relationship with their clients. So we managed to account for how many customers had active loans with those institutions. So just as an example, in 2020, there were about 15 million customers with active loans with these institutions. And 3 years later, in 2023, there were 60 million, 60. So from 15 to 60. I wouldn't say this is necessarily a bad thing. Kind of reflects, the digitalization we're seeing in the country and those new institutions coming and, more competition. And this is kind of reflects the environment that we're seeing here in Brazil. But this is something new, and this is something, of course, we need to be concerned about when we think about consumer protection issues. So you asked me about steps we're taking. So first, and for several years already, we're trying to measure and understand, especially over-indebtedness and what leads citizens and customers to become over-indebted. So as Deputy Governor Carolina mentioned in her speech in the morning, we created a concept called risky indebtedness. I won't have the time to explain how we did that, the variables, but we use our administrative data, and we consider risky indebted citizens, the citizens with high probability of becoming over-indebted. So we started to measure and monitor and in terms of profile and where are those customers in terms of income and everything. And just recently, we started to use AI techniques using our administrative data to really try to predict and try to find early warning signals as well in terms of what leads someone to become over-indebted or risky indebted. We just started doing this, but just early preliminary insights. The use of credit card, revolving credit, if you use, frequently, and if you use your credit limit, a high percentage of a credit limit, if you're using like 90% of a credit limit, those kind of things we found that you become a customer with a higher risk of becoming over-indebted. So we're just starting that. We think this is very promising for us to, support our policies. And in terms of policy, in terms of steps, as you asked, we are, of course, concerned about disclosure issues. I mean, credit card issuance, it kind of explains partially that increase that I mentioned in terms of the customers with active loans. I mean, credit card issuance increased from 83 million active credit cards in 2017 to more than 200 million active credit cards issued today. So we are concerned about transparency and disclosure. Just recently, we had the chance to change our regulation, supported by an experiment that we did. This experiment, we had different types of statements, and we found that if someone has like a simplified statement, a credit card statement with more, highlighted information that kind of helps the citizen to make a financial decision at the time, we found that those people had more information about the credit card rules and consequences of, for example, taking a revolving credit than the other ones with a regular credit card statements with no highlighted information in terms of consequences of not paying your whole invoice and paying that in installments or taking revolving credit. So based on that, it allowed us to change regulations. So institutions now have to really disclose in a more simplified way. So when customers are paying their credit card invoice, they really have the information at least to comprehend more and make a more informed decision. So just very quickly, due to the time, another just examples we're taking. We have a regulation that obliges institutions to take into account customer vulnerability, to map those customers in terms of age, income, and even indebtedness, debt stress, and digital skills. So institutions have to map and map the risk and the relationship has to take into account those vulnerabilities. So this is something that I think the central, specifically our consumer protection department, our conduct supervision department is really working for that to evolve. And just to finish, also recently we have a legislation and a resolution from the central bank that obliges the institutions to have financial education measures. And it's not just that they can put like a module of financial education in their website and they're complying. No, they really need to have a financial education policy and consider the journey of the client and that relationship and the journey of the client in terms of, for example, taking a loan and the complexity of different products, and the financial education policy must take that into consideration. Well, I guess
This is great. Thank you, Diego, for that comprehensive answer. Ayusha, I'm going to turn to you. I know that you have a major work that you are undertaking on fair digital finance. What solutions do you advocate for in this area from the consumer's point of view?
Firstly, thank you so much for having us, and it's been a great conference, I must say, for a consumer advocate to be here and talking about the consumers. I want to acknowledge the points that both Eric and Diego has mentioned about the perils and the promise of digital credit. It's definitely there. But one of the things that we need to point out and think about is who are these at-risk populations? Who are these people who are vulnerable in today's context? And we did a policy review across the globe, and we found that only 3 out of 10 countries had a definition of what vulnerable consumers meant. And I'm going to include what Brazil has also mentioned, that yes, we have a vulnerability framework in Brazil, and just few other countries where you have a definition of what vulnerable consumers really mean. If I open up the forum here and ask everyone's going to have a different definition of what vulnerable consumers mean. And that's been a big problem when we talk about the digital credit ecosystem. The second thing that we have identified is around creating a safeguard ecosystem within the consumer protection framework. We can say that consumer protection frameworks haven't kept up with the innovations of digital credit. We need to keep up with that. There are some examples I could cite of FCA's consumer duty guidelines that have come up, which have been really useful, and it's something that we should be looking at replicating across the globe. But the gap between regulation and innovation has created a lot of impact. And I want to cite some of the lived experiences of vulnerable consumers across the globe. The first one I would like to cite is of New Zealand. A high-income country has a very strong consumer protection framework, but you see the impact of the gap between the regulation and innovation in a way wherein we see a lot of consumers, most specifically women and low-income groups, households who are highly indebted. They are suffering from services like BNPL, who don't really share the transparent terms and conditions for them. That's been one of the greatest impact of this gap between regulation and innovation. Second I want to talk about is Pakistan. Pakistan has a great fintech ecosystem, but what we are seeing is that access to digital credit is limited and not provided to women and marginalized groups. So that's been another impact about access. And the other one is financial literacy in those particular groups. The last one I want to cite, and pretty much closer to home, is that of Mexico. Mexico, we have a large informal economy, and we see that the people who are coming from that economic background are facing a lot of over-indebtedness. They are having a lot of issues in accessing the right kind of products and services for them. And for all of these issues, there are consumer advocates who are advocating for them. And I want to cite and identify some of them who are present in this room as well. I want to cite IDEC from Brazil, who's been advocating for fair policies for these consumer groups. They have been instrumental for the over-indebtedness bill that got passed in 2021. I want to cite the example of TechCheck Mexico, who have been advocating for clear, consistent information being provided to consumers around digital credit. And finally, I want to talk about Consumer Council Canada. They have been propagating about proper financial literacy being given to the consumers across the globe, and in Canada especially. And finally, I want to talk about maybe just 5 things that if we could all work around and together to support these vulnerable consumers. First one is around standardizing regulations. Like in the morning, I remember Frank mentioning that we need to have a common lexicon. We need to have a common understanding of who we are trying to protect in digital credit ecosystem. So that's one of the things that we need to look at is standardizing regulations. Because when we have clear, transparent regulations, we are protecting the consumers on ground. The second one I want to talk about is data sharing frameworks. So secure data sharing frameworks can improve credit risk assessments, reduce costs, and prevent over-indebtedness. We've seen that across a lot of countries. And third point I want to talk about is outcomes-based regulations. Vulnerability as a definition is evolving. At a point of time, we all might be vulnerable to digital credit ecosystem as well. So how do we ensure that we're focusing more on the outcomes of the consumers and not just the risks and the innovations that we're trying to work on? How do we ensure there is positive outcomes? One thing that we can do is we can ensure that the lenders are made accountable for the positive outcomes of consumers. They should be accountable for reporting for the positive outcomes that they are generating from their services. So that's something that we are advocating for. And lastly, I would like to talk about is innovation with consumer safeguards. So I'm talking on behalf of almost 200 consumer advocacy groups globally, and I'm saying we are pro-innovation, but we want to ensure that innovation also safeguards consumers. So how are we empowering consumers through your innovations in digital credit? That's the ask that we have for everyone present here. I'm going to leave it at that.
Thank you, Ayushi, and thank you for the great work you're doing. I want to turn to Mercedes now. Mercedes and I met earlier this spring, and I was talking about this topic, as I often do, and we were having a conversation, and one of the things that we were discussing was this issue of digital credit and how sometimes, although the amounts are not large, the non-payment can lead to re-exclusion because clients can get negatively listed in the credit bureaus and therefore become re-excluded from the financial system. And then Mercedes turned to me and she said, I don't draw data from the credit bureau. I use satellite images to approve loans for SMEs. And that's how I am changing the ecosystem. So Mercedes, I wanted to ask you a little bit more about your model and maybe linking back up to the topic of this panel, how do you think about identifying early warning signals in a market?
Thank you, Natasha. Thank you for the invitation. Yes, I think I will bring the optimistic point of view from the practitioner. I'm a weird practitioner because I also come from public policy, so I have both views, and I'm trying to do something that, changes the way in which we are offering digital lending. I think that one of the points in which we should look at is that, maybe we are thinking on digital delivery, but also we should be thinking on digital as a way of personalizing the loan offer to the person, right? So in our case in Kipu, we are focused on productive loans. We are not focused on consumption loans. And I think that that makes a difference in how we profile, in a way, the user. So basically, what we are focused on productive loans for micro businesses or independent workers. This could be from a street vendor to someone that has a small restaurant in the informal settlement or a public housing neighborhood, like that type of small business. But even though there's more than $1 trillion gap in funding these businesses across Latin America. So still, obviously, there's over-indebtedness, but at the same time, there's still a huge gap on how we are providing services. So 80% of these businesses in Colombia, that's where we started, they are informal. This means they don't have financial statements, they are unbanked. There's no way we can do the risk assessment of their business. So what we started to do is looking at non-financial information. So we started looking at videos of their business, at images of their products and where they are located. We are looking at SMS from short numbers. So basically we're looking at, okay, how many messages from bank institutions are you getting? Are you already getting like banks telling you that you need to pay? So that will be someone that it's over in debt, right? So what we're trying to see is, okay, is this beyond the person that it would be probably blacklisted or it would probably have a bad report in the credit bureau? 90% of our clients have a bad report in the credit bureau. Beyond that, how we can assess their business. So is this business, profitable? Can this business have a future in the neighborhood where it's located? And we use, obviously, AI to assess all this information. It's been 2 years of experimenting, trying out different types of data, and now we reach a point where we are already using 100% our scores. They are more efficient than the credit bureau in assessing these really micro businesses. One of the things that we are doing with help of the IDB lab is on how we build an algorithm that is equitable. This means how we don't reproduce gender and racial biases. This is one of the things that came out in many panels. We're doing two main things that I think are important when we think of AI, which is not just the algorithm we're using, but actually the data set we're using. So our data set is diverse. We are the ones collecting the information. It's not just information from the cloud or the internet, but it's actually information that we are capturing, non-structured, per each of the clients that are applying. This needs to be diverse, right? So 52% of our clients are women. So this is important in the sense of like how diverse is our data set. And the other point is that just 20% of AI jobs are led by women. So then the models are trained by white men, right? So then the outcome will be also reproducing biases. So our team is led by women. Our AI team is mostly composed by women. So this is the way in which we are thinking on, okay, yes, there's a problem, but how we can find new ways, alternative ways of discovering who is not as bad or whose risk is not as bad as we think if we look at the traditional way of scoring. So yeah, that's what we're doing.
Thank you, Mercedes. And I'm sure there'll be lots of questions for you. Let me ask my team, before we go to audience questions and remarks, if we have the video from Francis ready to go. And let's look at what Francis says we learned from Kenya.
There are 3 lessons that other markets can learn from Kenya's journey with digital credit and negative credit history. The sharing of credit information in Kenya started in the early 2000s, and this was on the back of a couple of bank failures that had started in the late 80s towards the 90s, but had primarily been caused by serial defaulters. In 2003, amendments to the Banking Act were made to facilitate banks to start sharing credit information amongst themselves. However, this change in law only compelled banks to share negative information and not positive information. As a result, what happened was that the whole CIS mechanism was associated with blacklisting, a negative perception that still holds to date. With the benefit of hindsight now, it could be that these banks should have been compelled to share both positive and negative credit information. 10 years later, in 2014, new changes to the credit information sharing regulations were introduced. These changes provided for the participation of non-bank credit providers in the CIS mechanism. In the regulations, these non-bank providers are referred to as third-party credit information providers. It happened that around this time, there was an explosion of digital lending in Kenya. That meant that most of the third-party credit information providers were digital credit providers, or DCPs. So there were 2 things that were happening. On one hand, you had this explosion of digital credit, very cheap, if you could use that term, and easily accessible. And on the other hand, you had these DCPs who were not compelled to share positive information and were mainly sharing negative information. What that led was that there was a significant number of people who were negatively listed. What should have happened was, 1, the change in law should have been accompanied by more regulatory oversight in terms of the submission process, and there should have been compulsion for these third-party credit providers to not only share negative information, but also to share positive information. In 2020, CBK published new regulations for the CIS mechanism. One of the changes that these regulations introduced was a minimum threshold of $1,000, or approximately $7, on negative credit information that could be submitted to the bureaus. In 2022, the central bank again published new regulations for the supervision and licensing of digital credit providers. You could say that this was the first major step that the central bank took in the regulation of digital credit providers. Kenya is well known for digital credit, and much of the explosion of digital credit, one could argue, was because there was no entry barrier in terms of regulation, which we now have. To an extent, the growth of digital credit in Kenya can be attributed to it. However, given the harm and the conduct issues that were associated with digital credit providers, insofar as negative credit history was concerned, you could say that these regulations should have come much earlier, at least regulations that touch on the conduct of these providers. Of course, these lessons are peculiar to Kenya, and they are relevant given Kenya's context, but I think they are applicable to other countries and other jurisdictions that are also on similar journeys.
Thank you. So we have rushed ourselves a bit to get to this point and now be leisurely and relaxed and have time for discussion with you. We welcome your remarks, observations, and questions. If you make a remark, that's okay. And if you have a question, perhaps it would be useful if you state who on the panel, or would you like the question to be directed to, or perhaps even to Gabriel Davel. So I will open it up to the floor now, and we really look forward to hearing from you. Jayashree, you're first.
Sorry, I couldn't keep my hand down. So thank you, first of all, for raising this topic, and it's something that I know, we've been thinking about at CFI. I know CGAP's been talking about it in a bit. Debt stress is complex, as Gabriel pointed out, and one of the things, and I heard Ayushi say that, there's a need to hold lenders responsible for positive outcomes of consumers. I think it's tempting to do that, and, we tend to do that. We've done that in the past. There are a number of problems that I see if you look at the past experience of microfinance. One is that the digital financial landscape, as Eric pointed out, is so complex and changing so fast that adopting static measures like certification will quickly outdate the business models and is not really a solution. So how do you hold lenders or providers accountable? The second is that the lives of the consumers are also dynamic, because they are going to experience a lot of things at the household level, shocks at the household level. But a lot of this is also impacted by macroeconomic shocks. So you have inflation, you have food insecurity, you have climate shocks, and all of those are going to affect stress levels in their household, which happens usually after the loan is given. So again, to hold a lender accountable for something that happens in a consumer's life after you've actually assessed them for the risk is a little hard to implement in reality. So I'm curious to know what you have in mind when you say that.
So I think one of the things that, I should have, from the conscious of time, I didn't share much more in detail about, what we were trying to say out there. So one of the things that we see is that when we're talking about monitoring the financial outcomes of consumers, one of the key things that we have identified is the capacity amongst the supervisors and the regulators to understand, when you provide these services, how beneficial or harmful it's been for consumers. And putting all that burden onto the supervisory and the regulatory board, we've seen that's been a challenge. So to kind of address that burden on the supervisory and the regulatory bodies, we have recommended that this accountability should also be on the lenders, and this for the positive financial outcomes of the consumers, not about, should we provide these services to the consumers or no, but if we provide these kind of digital credit services, does it lead to positive outcomes of the consumers or no? Are we ensuring their well-being from a financial standpoint? Are we ensuring that the consumers are making informed choices or no? That's been like one of the things that we're trying to advocate for, and that's what I was trying to say, and that was the context behind ensuring that the providers are held accountable for, from a monitoring perspective of the positive outcomes of consumers. And on the standards, yes, I agree with you around, standards can get outdated, but we need to have some common taxonomy here, and that more specifically around vulnerable consumers. Who do we consider vulnerable? And I see that FCA Consumers Duty talks about, principle-based guidelines approach, which is, something that we could look at from mapping the outcomes as well.
Comment, and then I promise I'll stop. So it sounds great, and it works perfectly well in a market like the UK, because we have to remember that you have debt counseling, because you have the Citizens Advice Bureau in the UK, and you have fairly strong insolvency laws. So if somebody declares themselves as bankrupt, there is a way for them to still come back and be part of the, of the financial system. I think we have to think carefully about this in other markets where similar laws and credit market infrastructure may not exist. And so we shouldn't run the risk of excluding people who've once been included, and then, something happens and they can never come back again.
Thank you, Jayashree, and I, as you know, wholeheartedly agree, based on my work on over-indebtedness, on the importance of having systemic ways to assist consumers when they become stressed with debt. And I find that it's important to have solutions that don't only rely on the level of the financial service provider or the level of the client alone, but having credit counseling and legal mechanisms for clients to declare bankruptcy, as Jayshree is saying, I find to be quite important as bookends to a functional financial system. And sometimes I find in conversations like this, we forget that there are financial system level issues that can be done to assist consumers. I'm going to move us along, if that's okay, to see if there are other questions. And as you know, I love this topic, so I could spend the several hours on it. But is there a quick...
Just like a quick rubric here. So I think where I was coming from was more about not putting all the burden on consumers and ensuring that each and every stakeholder has some level of accountability when it comes to digital credit.
Good. Okay, great. So over to Paul.
Well, lots of questions, so I'll keep this brief. Just in reply to Jayshree, there's some work from the FCA actually looking at what is life events and what is predictable, and I think that's where we should be thinking, right? Like, we can't hold firms accountable for idiosyncratic shocks to households. Like the macro picture, they should have a better hand of, but the idiosyncratic, I don't really mind. But there are lots of things that are predictable. So debt to income ratio in the UK, for example, is very predictive of who's going to end up in financial distress. My question is actually for Mercedes, is to ask about her portfolio and what kind of default rates and payment she sees, and what's the growth here of the micro and small enterprises that you're lending to?
Okay, I go. Great. Yeah. So basically, we've been seeing a decrease in the default rate as the market is increasing. And that's basically because obviously at the beginning we started just trying out new data, right? So we were allocating capital based on data that we expected to have some relevance in assessing credit risk, but we didn't know. So then we started seeing decrease. Now we are at market standards, so we are below the default rates of microfinance institutions in Colombia. And as I was saying, 90% of our clients are blacklisted from the credit bureau, and still, we are showing that there's still people that are left out that could be included if we are thinking on their productive activity, right? If the loan is going to build something, so then it's easier for them to pay back than if the loan is going just for a consumption or an emergency, and then it's more difficult, right, to pay it back. So yeah, that's what we've been seeing in terms of default rates and how it's working. In terms of how the businesses are growing, we are just starting with an impact evaluation. We haven't done it yet. It's something that we have been assessing. We know that they increase more or less 15% since they get our loan, but now we're doing a more proper evaluation also with the IDB, trying to understand if actually an AI model is giving more access and at the same time is helping them to grow after they get it. One of the things we are doing is a WhatsApp assistant using Gen AI that helps them in a personalized way, like the education you were saying, but in a personalized way on how they can grow their business. On social media, or how they can, the typical things we are teaching in the microfinance industry, but with an assistant on WhatsApp. So yeah, I hope I will have more numbers.
Thanks, Mercedes. Chanchal?
Yeah, thank you. Thank you, first of all, very good panel and presentations. Thank you. I don't know whom some clarity I need, because I am quite confused, if not worse than that. There is a two situation. We have there is a huge gap of finance throughout in both individual as well as SMEs, and there is a huge and there is a positive aspect of the digital transfer and digital, so it's less costly. There is no leakage, and there are so many efficient part of it. Now there is a huge gap, and there's an efficient system, but still it's creating indebtedness. So now what is it that is it the digital credit itself? Is it the regulatory aspects? Is it, can this be comparable, whether digital credit and versus not? Whether is there something is called ceteris paribus, which is other things remaining the same? Can you really say so? If this is so, then everywhere this should be, digital credit should produce the same results, but which is not the case. So therefore, these I perhaps request much more examination and look at it. Thank you.
Thank you. I'm going to use the privilege of the fact that I am the moderator to try to tackle the answer to your question first. And maybe Gabriel will want to jump in if he wants to. If I understood your question, what you're saying is, how do we know, is it the digital credit that over-indebted the client, or what is it in the mix of the portfolio of liabilities that an individual consumer might have that cause the over-indebtedness? And did I sort of understand it correctly? Partly. So I will answer the question that I understood. From my own work on over-indebtedness research in Bosnia, what we learned is that it's very hard to pinpoint any one loan that caused the person to be over-indebted. Usually clients have, as we know from portfolios of the poor and other research, clients have several sources of liabilities that they're juggling. And they might have a source that's from an informal lender, they might have some friends and family borrowings, perhaps a commercial bank borrowing, perhaps not, another co-op or a microfinance loan, and maybe now, in addition to all of that, there might be an instant nano loan in the mix. The reason we talk about credit counseling is because what I have learned in the work with the demographic that I worked with is that it's really important that at least someone in the system has a full overview, the complete picture of all of the liabilities that one single client has, so they can help them overcome it. But what I also found is that it was not a useful exercise for me to then try to assign blame or to say, well, this one loan is what caused the client to become over-indebted. It's the ratio of what percentage of their income was going to service debt. And I didn't find it useful to try to pinpoint any one single liability that they were experiencing. I hope that this gets to answer your question. I'm going to go to Patricio, who was next, and then Fiona, and we have 9 minutes left, and I think we can get to everyone. So Patricio, over to you.
Thank you very much, Natasha. The name of this event is Responsible Finance. And at the beginning of the day, we saw the attachment of the concept of accountability next to responsible, right? We have arrived to the conclusion that regulators and policymakers are accountable for responsible financing. But there's the private sector too. And on that sense, financial services providers are also accountable for digital credit over-indebtedness. I would like to ask Mercedes, who represents the private financial sector supply of credit. How do you see responsibility or accountability from a private perspective, taking into account that the customer can be approached by many competitors at the same time? So my question is, how do you see accountability on your area, knowing that competition is there and also the desire for financial inclusion?
Great. Yeah, so the main competitor we are seeing right now is the gota gota, that it's a predatory lender. So the problem today is that everybody, in a way, have access to capital. The problem is how they are accessing capital, right? So they are accessing capital in an informal way, in a violent way, in an analog way. These are people that go to your house with a motorcycle, give you the cash in the moment, and then they will be violent. And they would charge up to 800% annual interest rate. So I think that that's our main competition. We have an association of fintech in Colombia where we, in our websites, like we are the ones that are legitimate in a way as lenders. I think that's the main problem we are seeing right now. The other way in which we are accountable and responsible, that this is why I started Kipu, right? I don't want to be rich. Like, I want just to try to show the world that a different solution is possible. So I started to see that if we, for example, it's better for the business if we give loans really short term. But this is causing more default because our client cannot pay more than $70, even less, like $30, sorry, per month. So then depending on the amount we approve, it's the amount of months they have to pay back. So that's one thing that we are doing, that obviously the short-term loan, as I say, is easier for us, would be easier. But in the end, if we want to really help their business, then we need to give them more time to pay. The other way is that we start with a small amount. So they start at $100 and then they increase in a staircase model their amount of loan. Even the loan is going for a productive purpose, this is a way in which we take care of the customer and we don't give them like a lot of money in the beginning that actually they don't need. They think they need, but in the end, maybe they don't know how to handle debt. So for us, I think it's at the core and the values of our company, and it's why actually people come to us, right? Because they know that we want to help them. And we are not regulated because we are not capturing money. We don't have savings, we just give loans. But still, we have this fintech association, and I think that we are, supporting one another also in this network, and also supporting our customers on saying who are now scams, because there's a lot now of digital scams. So it's in the everyday practice and the values of the company that I try to get that accountability.
Thank you. Mercedes, Fiona, the floor is yours.
Sorry, my name is Fior, and it's from Mexico, but don't worry, it's difficult. From TechCheck, online digital consumer protection in Mexico. Just 3 facts to contextualize my question. In Mexico, only 49% of the population is financially inclusive. At the same time, 48% of the people that it's in the financial system report feeling worried about accumulating debt. At the same time, 50% of the complaints received by the authority in Mexico are related to unrecognized transactions and refusal to adjust credit balances from the providers. So highlighting the Ayushi's comment to more innovations to empower consumers, I want to know from the regulator, private and organizations, consumer, what collaborative measures we can develop to ensure consumers have better information about their payment capacity, and something very important for TechCheck, the right to complain and redress. And please, beyond chatbots, as Gabriel already said.
Okay, from my point of view, I mean, we've been discussing a lot this morning about open finance. At least in Brazilian case, I can see open finance as a potential to decrease this information asymmetry to spur competition. I think that would be, at least from my perspective, a way to have more information flowing, and so I would say that would, that would allow, better assessment of credit. This is something that we've been concerned about in terms of a limit of credit as well. As I mentioned in our just recently AI experience, we've seen that if a customer is kind of getting to close to their limit of credit, they are already in a very high risk of being over-indebted, at least from our perspective. So this is something that concerns us in terms of, okay, is this credit limit, is this assessment correct? Because they're not there yet, but they already have a high risk of being over-indebted. So I guess for what I think now is maybe open finance can help in terms of information from the clients to flow and and be better assessed and I mean.
Eric?
Okay, so I think it's a complex, it's actually two different questions, two in one, and they're not easy, but I'm going to come back to where I started with this notion of ecosystem, and it's related with the notion of accountability. I think we need to build this joint accountability for producing the right outcomes to consumers. So when it comes to repayment, having consumers who have a better repayment capacity, well, consumer associations can help consumers better understand their own capacity to repay. But then you have also providers of financial services who also have a duty to sort of measure the repayment capacity of their consumers before giving them a loan. And then you could have regulations that actually regulate that give you debt income ratios or other types of regulations that really states that it's really critical to measure repayment capacity before providing a loan. And then on the rights to complain, I would say the same. You need regulation, you need supervision, you need to ensure that consumers are actually able to complain. It's not just providing a hotline. We've been talking a lot about outcomes. The regulation and the supervision should state that the consumer has the capacity to complain, and the provider should demonstrate that the consumers have a capacity to complain. So again, this is where several actors again need to be involved to ensure that consumers really can get more responsible digital credit.
Thank you, Eric. We are at time. I wanted to thank my panelists for working to prepare and for being here with us today, and I'll hand us back over to Frank. Thank you, everyone.